I can't believe we're doing a whiteboard video on this channel. I avoided this as much as I could because I think it's super gay, but we're doing this. I've read somewhere that the reason why whiteboard explanations are so successful is because the amount of time that it takes for us to write stuff on the board is the exact amount of time needed for somebody to internalize a new idea. I have to mention that I did not clean this corner of my apartment, and I'm sitting in dust and dead bugs. Let's get into it. The first issue that I've mentioned is a misalignment between founder vision and investor expectation. I'll explain it in layman's terms. So you as a founder, you see the roadmap, the trajectory of this business. You see it. You know that if you get some money here, then you'll pay for some stuff, and then you'll have a milestone here, and then another one here, and so on. You understand that the business itself will be growing. Well, you're going to be spending some money, then spending some money, then you're not really going to have any returns. The investor, however, has given you a big chunk of their savings, right? And they don't know business. They're not even supposed to know your business. I need to show something else. I need to show that the business itself, its existence, was from nothing at this point and started to be something. Actually, it started to be something like this here. And then maybe constant, not that big, but then huge here because it's another milestone. And so on. So you see the business like this. It just keeps growing and existing, and more people know about it, and you start having distribution and traction and going on podcasts and stuff. Ugh. But the investor sees only one thing. Sees that they had some money in the bank, and now they don't. So they started their portfolio here. Negative 100K. And they look at your business, they see you spending, but in their minds, as time passes, they're like, they're confident. They tell their friends at first. They say, oh, founder versus investor. So, you're familiar with the roadmap. They kind of understand the roadmap, but not that much because they're not the ones building the business. And you spend the money, that 100K, you're plus 100K at this point. You feel amazing. You just raised some funds. You just raised some capital. And now you can spend so you can have some runway, have some business. But the founder, however, is left with negative 100K. And at first it's not a problem. Let's say it's the vision kind of goes like this a little bit, And maybe they ask you at one point, have you reached your milestone? And you go like, well, not yet, not yet, I don't know. Because usually the milestone, you say it's right here, but it kind of moves somewhere here. And the delta between this milestone and this milestone means in the eyes of the angel investor Oh my God, you didn't reach the milestone. Whoa! Okay, you reached the milestone. That was weird. And then this thing keeps going on. You know, he's kind of happy because he sees you on the news, back here again. But then, oh, there's another delay. And then you kind of fix it. And then he's okay. Maybe even tells his friends, yo, I invested in that thing. Did you see it on the news? And then, oh, you haven't raised any more funds. It's only my money. And so you sometimes, as the founder, have to deal with some calls. Some nasty calls. He's not going to bother you here. He's going to take pictures with you here. But a solution for this issue would be, of course, a third party. Now, what does the third party do? I will just make some drawings so you understand. Between the founder and the investor, there has been an exchange of capital for an exchange of promises of potential upside. 2x, 3x, who knows? Okay? The third party kind of oversees, because like the third party is in charge of this thing, of this communication. You know? I put it with black. Yes, there have been delays because blah, 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 blah. Yes, these would be your expected returns. Yes, I have calculated this. Yes, how soon would you like to obtain dividends? And at the same time, yes, if you would like, you could sell your rights if you don't feel good about it. And third party can oversee it. This is one of the major values that I bring to the startups that I work with, because ultimately founders need to focus on the business and investors, they need to focus on their returns and the chances of them getting those returns, but not the business. That's gonna mess up your vision as a founder. You're already working 16-hour days on this thing. You've lost some weight, lost some friends, lost a spouse on the road. But yes, a solution is a third party observer, the third party evaluator, third party calculator. The beauty of a lawyer. But before we get to expensive lawyers, advisors would be enough. I think I messed up their whiteboard. Oh, the second issue, the second huge pain between the founder and investor relationship is the psychological debt. Again, I will go founder, blue, and investor with red. Okay, so the psychological debt is kind of, I guess it's a human limitation as well, because we know that if we get a loan from a bank, it's from a faceless entity, and at the same time, we know that we're paying through our noses via interest. So first of all, we hate banks because they have no face, and second of all, we're paying money for that money anyway. In this case, if they invested to get equity, the payment itself lies within the business. We're going to do the roadmap again. This is how you plan the business from the beginning. And you have some milestones, and you yourself see that milestone 1 is being delayed. Maybe put it with green. Milestone 1 is being delayed. Oh, and it's costing a little bit more money. Milestone 2 is being even more delayed, because it's this delay plus some extra delay. So it's maybe 2x delay, 1x delay. Unavoidably, in your mind, you're going, oh my God, I'm not going to be able to pay this person back. Oh my God, they've helped me so much. Oh my God, am I treating them properly? Am I buying flowers for this lady that invested 100K in my business? So the psychological debt accrues every time you have these little delays. Let's say we're we're not going to call it a debt because they bought in equity, yes, 100K. But then it's going to be 1x. And then for the next delay, it's going to be 2x. And so on. I understand, and it's a really bad feeling. But think of it this way. You could have opted to get a loan from this person. You could have, let's see, you could have said, give me 50K and I will give you 75K. But like, until then, I will give you monthly installments, teeny tiny, and then I give you lump sum at the end. Well, yes, Serena, what about the collateral? The collateral can be equity, and now we're going into, well, this would be a hybrid between a convertible note and private debt, but you really need to check out my video on safe versus convertible notes, because one's a loan and one's not. But yes, would you be more comfortable in this framework in which you give back a teeny tiny chunk of the money to the investor? I am not very sure. I believe that if you do that, it's really going to affect your cash flow. And that really wasn't the point of raising funds in the first place. You wanted to raise funds specifically to have some extra capital to do high growth, rapid growth, to get you over a hill at the right time in the market. And so, instead of giving them their money back, you can start, if you really feel like it, you could actually start saving a little bit, saving a little bit, saving a little bit, saving a little bit. And let me tell you what happens if you do that. And I will also share after this the number one priority that you should have when you raise funds, or like the most important play. So the thing is, when you start saving a little bit of money, maybe at one point you start having revenue and you put some money to the side, maybe you raise more money. What happens is that each month this pot grows, right? It's month 1 and then month 2 and then month 3 or whatever, quarter 1. And this pot gets this big. And you know what you could do with this pot? You could get interest rate on your term deposit, on your savings account, interest rate. So what I want to say is that you should always keep in mind the capital efficiency. Because the reality is, and I will teach you something here. Remember when I said that's not how you spell efficiency. Remember when I said on the terrace that this is going to be a little bit of CFO coaching. The reality is you're going to get 100K today, but you won't need to spend 100K today. So my advice is to make deposits, a 10K deposit, 220K deposit, we're up at 50, 225K deposits. And the term for these deposits should be according to your planned expenses. Like obviously, you're gonna have maybe a huge chunk of expenses here, and so the 25K goes away. There's only gonna be, it's gone first trimester or first month, whatever. But then you can start juggling. Maybe this one is gonna be like 6 months or whatever. This is gonna be 6 months, or 1 6 months and 1 3 months. And this may be another 3 months, although I would put it at 6 months. You need to plan your savings account with your interest rate according to your calendar of expenses. And maybe you don't need a $50,000 logo. Maybe you don't need high-end offices. Like, keep it as lean as possible, because like I said, this initial investment, I say 100K because it's easy, because it's like 100. This initial, we could say 1 million. This initial investment should offer you the runway that you talked about, because you needed runway to grow the business, to not worry about sales and things like that. Well, yes, that means if you have a runway that has been designed, you also kind of already know what you're going to spend this money on. And of course, be flexible according to how much money you raise. And always put the money in the highest value things, and they are not necessarily marketing. You got to make that money make more money in either securing monthly recurring revenue or yield on capital. And the most important thing that I need to tell you is that you want to have the cash as soon as possible from the investor. You're not gonna, many people kind of avoid. They go like, you keep the money and you just give me 10K now because I need to spend it on something. Give me 20K now, because I know why you do that. You do that because you are used to a certain amount of money and you're not used to this certain amount of money. And yes, money is a spiritual thing, because if you're not prepared to hold this amount of money, you will lose it. So you need to design some things. I personally, in 2024, had way more money than I was used to in my account, and I freaked out. I literally panicked. There were 4 days, like the wire transfer hit my account on Monday, and on Thursday, I had a scheduled meeting with the portfolio manager. And those 4 days, I was super stressed, because I was, oh my God, I'm going to lose everything. I'm going to lose. What am I doing? This was my current account. And so in 2024, I did not know what I was doing. And so I hired somebody to do that. I hired somebody to educate me. And it was, I love her to death. And it was a learning process over the course of, like, even today, I still learn from her. And she calls me up and invites me to these, like, investment banking conferences and stuff, in which we see the state of the market and, like, worst case scenario, best case scenario, mid case scenario, and probability for all of those, for everything, for like Forex, international stock markets, industry sectors, and so on. And I've learned so much over the past 2 years from her. I love you. So hire somebody. Like, perhaps as soon as you have this money, maybe you kind of need to hire somebody that is not your bro CFO, somebody that oversees the capital efficiency and stuff. And I'll be completely honest, before starting shooting this video, I was like, I went downstairs to my neighbor and I saw some other neighbors of ours, and some of them are fitness coaches. And I was like, why, out of all things to coach, I chose finance coaching? I could have also been a fitness coach. I would have looked hotter and my life would have been a lot simpler. But no, I chose the most complicated thing. Psychological debt can be eased with proper financial planning and with designed capital efficiency and foresight. And some grown-ups in your business. Pain point number 3 is cap table complexity. Now let's draw some cap tables. I like to draw them like pie charts because I think it makes more sense. So this is the business, a donut, and you're blue guy, founder, you have 100%, because you founded it. Then, you start raising money. Ideally, you would use equity derivatives, but at one point, those derivatives will convert into equity. And you'll reach a point, perhaps during seed round, perhaps during Series A, in which you got an angel investor, a bro who offers services. This is the worst case scenario, by the way. And maybe your grandma. And you're left with this much. I don't know how, it's less than 50%. And you got bro here, who, the only reason why bro is here, because you panicked and you offered him 1/3 of the business. But then you also offered some equity to your grandma and to your neighbor. Don't do that. Don't do that, please. Don't do that. Okay. What you're going to do is, first of all, you need to design funding rounds. You need to know how much this business is worth today, and you will have funding round 1, which is pre-seed. Shout out my video, which is the ultimate funding round guide. You will have seed, you will have Series A. You need to know how much the business is worth, so you can say how much money you're going to raise for how much equity you're going to give. So you need several variables here. You need to, I'll just put them here because you always need these. You need valuation. You need equity given, the sold. You need ticket sizes. None of this 10K, 1%, whatever. Ticket sizes only for the people who can afford to buy in. And you need something called an option pool. The option pool is some shares left on the side that you can give away for employees if they're on a vesting schedule, or partners or advisors. People, you get people to care with the stock you have left in the option pool, not with whatever is left. Because just think about it, like if you want to make people care about your business, then you're gonna have to chip away at, here's some of mine, here's some of mine, here's some of mine, and lo and behold, you're a minority shareholder in your own company, my friend. And you didn't know when that happened because you were too busy building the business. And you might even end up going on vacation and coming back and see that you are no longer head of that company. It happened to many. It even happened to Elon Musk at PayPal. When he finally had his honeymoon and went to Australia to also raise some funds, he came back and Peter Thiel eliminated him as CEO. And he took it like a pro. He took it on the chin and he stayed on the board and he kept investing. Anyway, for pre-seed round, let's draw the option pool. The option pool we keep at 10%. It's just pre-seed at this point. You know, we're just starting. It's just starting this thing. And you give equity between 10 and 15%, but I think 10 would be better. Let's say 10. This is how much you sell. And you pay attention. This still remains you. You still have obviously control of the option pool because you're CEO and whatever, manager, head of whatever, head of equity. And these people that bought in this 10%, like they could only afford, I don't know, a maximum of 5%. Maybe you sold the whole 10% to somebody, I don't know. But ideally, you know, maybe two people with 5%. Now we're going to seed. For seed, every time you finalize a funding round, you issue new shares, which means that everybody gets diluted. At the same time, these people, red guys, can sell their shares, which will not dilute you. It just grants them liquidity, and that is called a secondary sale. For seed, at this point, you need more people caring about your business, and so maybe we raise the option pool, we make it 15%. The more people care in your business, the higher the chance the business has of succeeding. You could be baller and sell 20%, and you already sold 10%, that becomes like 8%, or maybe less, 7%. So these people that used to have 5% now have 3.5. This is very specific to the US market, because they also have preferred shares and not common shares and stuff like that. What usually happens here in my hometown is that these stakeholders get bought out, and there's nothing wrong with that. Anyway, 15-20% seed round, and of course it's the same. Its ticket sizes ranging from 5% to 10% and another 5%. So you got 3 people on the board, maybe you have 5, I don't know. And so this is you. And yeah, it's not looking good. Like you're maybe at like 60% or something, but it's fine because you're still majority shareholder. And by the way, you keep controlling the option pool, you know? Okay, for Series A, we're not that extreme like in the seed round. Because in the seed round, like everybody wants to get in and stuff. They want to benefit from the upside because there's like really, really high growth potential here. This is super high risk, but it's, you know, family and friends and whatever. But like seed round, is where people want to get involved and benefit from the upside. And that includes institutional investors as well. Well, VCs. Institutional, I keep calling them institutional investors. VCs. There are many, many VC funds that are actually interested in pre-seed and seed, because the thing is, they look at your business and they will give you the money despite the fact that it's super high risk, if it's looking like your business can return the whole fund, you know? And after Series A, B, and C, blah, 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 like, there is, of course, high growth potential, but not as much as this, because like at one point you kind of exhaust the market and maybe you start diversifying the business. You do like vertical integrations or horizontal integrations, but you know, those cost money to make money, and so it's not going to be such high yield. Like, this is the sexy thing, because the business is like super lean and new and sexy, and you know, people are okay with it. I will draw the corporate life cycle. So we have young growth stage, high growth stage, mature growth, mature stable, and decline, because this is inevitable. This is inevitable with the business itself. It either diversifies or this is what happens. Because the market at one point, you exhaust the whole market. You exhaust the whole market, you exhaust your whole marketing, like you have to invent something new, otherwise you're done. And this is the corporate life cycle from Professor Ashraf Damodaran. I keep quoting him. He's even in my book. If you want to check out my book, it's called The Informed Exit. Shameless plug of my book, but you really need it. You really need it. Anyway, yes, like I said, when people take a high risk in pre-seed and seed, they're here somewhere, right? And they're betting on this. When we start having proper funding rounds like Series A, Series B and stuff, it's still growth, but it's like, you know, it's not as spectacular. And then at this point, we kind of have to start looking into an IPO. And maybe I will make a separate episode on the IPO, because before IPO you kind of need to have some proper shareholders, sovereign funds. Yeah, I will make a separate episode about that. Okay, anyway, we're at Series A, and you can keep an option pool of between 10 and 15%, because like I said, like you're not trying to buy as many people as you were here, right? Like, it's stable growth. You keep like 10-15% of an option pool, and you give away maybe an extra 10%, which can either come from as a secondary sale from these guys. You best believe that these guys at this point, they really want to sell their shares, because it's been a couple of years. If this thing is growing, they're like, okay, fine, I don't really need to be in your business. Like, it's time for me to sell my shares. So your cap table is probably going to be looking like this, right? Like, let's say you're going to have 20%, maybe like this. 20% are going to be investors, and like is your option pool. The rest of it is you. These have several ticket sizes. Teeny tiny, maybe not that tiny because we bought them out, but like, you know, this big. And they're also, you know, they're invested in the business. Like, maybe you have business partnerships, it's like you have synergy, they hold, you trade, whatever. You will probably end up, after this whole ordeal, if these people don't sell their shares in a secondary sale, you best believe might be having like 40%. And it's okay. You still have majority. There's a whole bunch of people that really care about your business. And at this point, you yourself can even think about exiting your company. Because if your company is here, you're not helping it with anything. It really needs a refresher. And we're not only referring to equity, like doing an IPO and stuff like that. We're referring to the business growth, like you're done. Maybe if you are one of the 1% startup founders that could actually build a thing like this and succeed, and that means that you're a psychopath, that means that you're a psychopath, and that you are best in this stage, maybe this stage. But you know, at one point during this stage, you need to start buying suits. You need to stop telling everybody about your rags to riches story because nobody cares. You need to have some other people that talk instead of you, you know? And that's great. Like, congratulations. You just exited your company. And that's great. That's, everybody's happy. You're happy. You can take some time off, or knowing you as a psychopath, you're probably going to want to start this whole thing all over again. And it's your right, and it's your super unfair advantage, because now, when you start this thing all over again, you're going to be the guy who built this thing. Can you imagine? There's no convincing anybody anymore. It's a beautiful thing. There's no convincing anybody anymore because you already did it once. And chances are you'll do it again even better, because now you're like 40. You were 29 at the time. I don't know, 32. But now you're 40, and like, you're going to do this way better. And you already made some friends along the way. You've proven the fact that you are trustworthy. And so it becomes easier and easier. I have a cap table simulator which does all this for you. It's a tool that I've built and that I keep making better and better with the clients that I work with. And maybe I'll link it below. I don't know. I don't really have a plan for this. But don't get used to this video format. Check out some other videos on my channel. It's full of this stuff. Check out all the tools that I have provided for you regarding funding and exits. And I love you. Bye. Oh my God. We're not going to do these on this channel. We're just not. I hope you're okay with that. Go watch some manifestation videos with whiteboards, because this channel is about corporate finance. Okay.